Here with Herald van der Linde, head of Asia Equity Strategy at HSBC in Hong Kong. Herald, thank you so much for joining the Contrarian Investor Podcast. We're here because we're going to be talking about emerging markets and a couple of things with emerging markets that make this a good topic of discussion from a contrarian perspective. One is that the track record these last really 10 years or more maybe since the financial crisis, emerging markets have kind of underperformed developed markets. So while they carry more risk, typically they haven't really produced any of the excess return, at least not in recent memory. This premise that emerging markets are basically just tied to developed markets anyway, most of them supply the developed markets. And so therefore they're really just kind of a riskier poor man's version of a developed markets index that they track anyway, again, without the excess reward to go with the risk.
I mean, you are right if you say have emerging markets in Asia, have they underperformed over the last 10 years? That is right. But in a sense, that's also not correct because there is so many emerging markets. So yes, in Asia, for example, and Asia is about 2/3 of overall global emerging markets. So it's a predominant part of it, right? Yeah, there are markets that have moved in all sorts of different directions, and therefore they even each other out. And on the margin, they've just about underperformed the S&P 500. But if I would have said, listen, take a look, for example, at India, over the last 10, 20 years, India has done about twice as good as the S&P 500. China is a bit more complex because there are arguably maybe 5 or 6 Chinese stock markets now. There's one in Shanghai, it's the biggest. You got Shenzhen. Most people would buy their Chinese stocks in Hong Kong. You can also buy ADRs in New York. But yeah, these markets have moved in different directions. The ADRs, in particular last year, and most of them tech companies in the US, have not done very well. But the Asia market has actually done pretty good. And Shenzhen is mostly tech companies, has over the last 20 years done phenomenally well, about 1.5 times as good as the S&P 500. So again, it's all over the place. And this is, I think, really important in emerging markets of Asia, that don't just club them all together as one.